So in this video, we're going to talk about the triple bottoms pattern, and I'm going to show you in detail about how you can identify this pattern on your charts. And also I'll be sharing a very good profitable trading strategy regarding the triple bottom pattern on the charts, and we'll be going through the examples as well. Hey guys, welcome back. So in this video, we're going to talk about the triple bottoms pattern. Okay, so without any further ado, let's get started. First of all, we need to identify, or we need to learn how you can identify a valid triple bottoms pattern on the chart. In order to do that, there are some rules that we need to follow. So let's go through these rules one by one, and after that I'll take you step by step towards the trading strategy and also share some important stuff that is important related to this triple bottom pattern. So make sure to watch this video till the end. So first of all, the first rule is identify a bearish trend. So the triple bottoms pattern is a bullish reversal chart pattern. So in this, what this means is that the prior trend before the formation of triple bottom is in the bearish direction. So after the formation of this triple bottoms pattern, the bullish trend starts. So this is a bullish trend reversal chart pattern. So the prior trend should be bearish. So first rule is identify a bearish trend, formation of consecutive lower lows and lower highs. That means that currently the trend in the market is bearish. The second rule is draw a valid support using two swing waves. So here you can see that in order for us to identify this pattern, there should be two swing waves or two waves at the support level where the price bounces back. So here you can see the price is coming down and forming these lower highs and lower lows. So this means here the market is in bearish trend, and here you can see the formation of this support zone with this first swing and then this second swing. So this is a valid support zone because price is bouncing back from this level. Now the third point is catch a neckline meeting the two touches of the swing. In this case here, the touches of these swings are the highs of these swings. So this is the first swing here, and then this is the second swing. So this is the support level that we have drawn, and then this is the neckline. And after that, the third touch here, you can see that price bounces back from this support again, and here on the third touch of the neckline, the price breaks out, and after that the bullish trend starts. So what this means is that now after the market was in bearish trend, and here the triple bottoms pattern formed, the triple bottom chart pattern, and on the third swing, at the end of the third swing, the price broke out with a big or impulsive candle from this neckline, and this is basically the start of a bullish trend. So this is the valid way to form or to identify the triple bottom pattern. Now there's one thing important here in order for us to understand and learn this, that is that in order to have a good win probability for this pattern, the breakout candle that breaks out through this neckline should be a big impulsive candle. Okay, it should not be a pin bar or any candle with a small body, because that would not indicate that buyers are in good momentum. So let me just go through the psychology. So here, while the prior trend in the market is bearish before the formation of triple bottom pattern, the sellers are in full control of the market. Okay, but here when we see the support forming and these these touches happening, that means now the buyers are coming into the market and they're willing to buy. Okay, so what that means is they're holding up the sellers and price is not going up anymore. So it's just holding up in this region, and here what happens is ultimately the buyers take control of the market, and now they push the sellers away. So what this means is with this impulsive move, they just push the sellers away, and now the buyers are in control of the market, and that's what drives the market in the bullish trend. Okay, so this is the trading psychology or the market structure behind the triple bottoms pattern. Now let's go through the strategy that we can use in order to trade the triple bottom pattern. So here, first of all, you can see that this is the prior trend is bearish, and this is the first touch and this is the second touch to our support zone, and after that these are the points that are touching the neckline. So this is a valid triple bottom pattern, and on this third swing here we can see the price breaking out. So there are two ways to trade this. The first one is you can open a trade as soon as the price breaks out this neckline on the third swing, and then what we can do is put our stop loss at 78% okay, of the Fibonacci retracement of the third swing, and our take profit level would be the maximum distance or maximum number of pips that are between this neckline and this support zone. So that would be our target take profit. The one thing that I don't like about this pattern very much is that it has a bit low risk to reward ratio, so which means that it won't be very beneficial on itself, and that's why I would always recommend you to use this pattern with as a confluence or as a combination with another pattern that or any other strategy that you have, okay, because in that case it will help you optimize your risk to reward and also optimize your profit. So in this case here, what we can do is we can wait for the price to break out from this neckline and we can put our trade here, or we can also wait for the formation of a pin bar, okay, or any candlestick pattern that is after the breakout with an impulsive move. We can wait for the formation of a pin bar, okay, or we can wait for any candlestick pattern that confirms now the price is going to move in the bullish trend, and then we should take our trade, okay. So as I explained, your stop loss should be the 78% retracement of this wave, and your take profit would be the maximum number of pips between these two levels, okay, the neckline level and the support level. Now there's another important thing that a lot of people confuse. They confuse the triple bottoms pattern with the broadening wedge pattern, because in this case here you can see that it's very hard, like the support line would be just a straight line, it would be a support region, okay, it would not be a straight line. So here you can see the market making these swings and bouncing back from this support zone, and also this is the neckline forming here, and here the breakout happens. So a lot of people, what they do is they confuse this triple bottom pattern with the broadening pattern, because in the case of broadening pattern it makes a similar market structure, but it's very different, because in case of broadening pattern every next wave is bigger than the previous wave. So you should always keep that in mind, and also the market is making these higher highs and these lower lows, okay, so it's not moving inside a support zone, instead it's making these lower lows, okay. So this is the difference between this triple bottom pattern and this broadening pattern, and you should always keep that in mind. In case of broadening pattern, every next wave is bigger than the previous wave. So now let's go through the charts in order to see how this works on the charts, and let me just show you through an example. So here on the charts we can see that there is formation of triple bottom pattern because the prior trend is in the bearish direction, okay, and after that there is formation of these swing points or swings, okay, and the price is touching this support level and bouncing back from here for the first time, and then here for the second time, and here for the third time. And the neckline in this case is this line, because you can see the price or neckline, or it can also be called as resistance, or the proper way for this pattern is to call it neckline. So the neckline here is at this point where the price is touching this line, and we can also see the price bouncing back and making a swing from this point as well. So this is our first swing, this is our second swing, and this is the third swing. And on third swing we can see the price is breaking out from this neckline with a big impulsive candle, and after that the price moves in the bullish direction, okay, so a bullish trend continues or forms. So the trend has successfully reversed from this bearish to bullish after the formation of this triple bottoms pattern, and this is the support zone that is forming here, and this is the neckline. So our stop loss would be the 78%. Let me just go here and take the long position. So let me go here and let me open up long position. So our stop loss would be at 78% retracement of this wave, okay, so almost here, and our take profit would be at the same number of pips that are in between this support line and this resistance line or this neckline. So I would just project this here, and our take profit level would be somewhere here. So this would be basically our trade that we would be taking in the triple bottoms pattern, and our entry would be when the line or the price breaks out through this neckline, and that would be our entry point. So as you can see, the risk to reward ratio for this pattern is not very high. So what we can do here, we can look for the triple bottom pattern at a higher time frame, and a way to this is a very good way to optimize this strategy. So we can look for the triple bottom pattern at a higher time frame, and then on the lower time frame we can go into the lower time frame and look at some chart pattern or any candlestick pattern that is forming in this region, and trade using that candlestick or that chart pattern which has higher risk to reward ratio. So this is a very good strategy that we can use in order to optimize the risk to reward ratio for triple bottom pattern as well. I hope you guys like this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to